Have you ever found yourself wondering which portfolios produce the highest returns? There's so many variations in portfolio construction that it can be hard to evaluate which portfolios make sense for your specific financial goals. We've spent the last 5 weeks here analyzing safer investment strategies, but now it's time to talk about what's probably the most popular portfolio in history. This portfolio has produced so much wealth that it basically has become the de facto standard for investors who want to retire early. So stick around, because today we're going to finally dig into the mighty, simple path to wealth strategy. In the last episode of Portfolio Analysis, we investigated the Boglehead 3-fund and Core 4 portfolios. Both of these portfolios use the index fund strategy pioneered by Jack Bogle. If you haven't watched that video, please go check out that one first. Concepts in this video will make a lot more sense after you watch that video. In a nutshell, the balanced portfolios that Jack Bogle created using the index mutual funds he invented included asset classes such as bonds, international stocks, and real estate. Some investors started to think to themselves, hey, international stocks and bonds haven't really done very well in the last couple of decades, so what would happen if I just removed all the other asset classes and instead just invested 100% of my money in a total US stock market index or an S&P 500 index fund? And yeah, if you go back to the 1970s and run the numbers, this strategy does beat pretty much every other strategy. Well, so long as you don't need the money during the multiple times the market was crashing in this period. J.L. Collins created a blog, which he later published as a book called The Simple Path to Wealth. The ideas in Collins' blog caught like wildfire. It captured people's imaginations, and today this strategy is pretty much the standard investing strategy for people in the FIRE, Financial Independence, Retire Early movement. Before we continue looking at the strategy, we need to understand that there are several variations of the Simple Path formula. When financial advisors recommend the Simple Path to their clients, they're usually referring to an 80-20 or 75-25 version of it. For example, 80% total US stock market and 20% long-term US treasuries. Balancing the portfolio with 20% or so bonds drops the standard deviation from around 14% to around 10%, which changes this from a very high-risk portfolio to just a high-risk portfolio. I want you to imagine a 1-year timeline. In this single year, some stock pickers do really well, and some stock pickers do really poorly. Stock picking is a zero-sum game. For there to be a winner, there must also be a loser. When you average the returns of the winners and the losers, you get the market average, or the return that an index investor would earn. This is why index investing is called a free lunch. And this is why index investing is so hated by Wall Street investment firms. In any given year, you earn more money than 50% of all the stock pickers for doing absolutely nothing. Now let's add another year to our timeline. In the next year, some stock pickers have had a hot hand and they earn real good returns again for a second year in a row. But many of the stock pickers that did well last year didn't do so well this year. If we fast forward our timeline out 10 years or so, we see that of all the stock pickers that were doing really great in the first year, just a tiny handful of them are still winning 10 years later. If we assume we started with 100 investors, just 7 of them have managed to beat the market average over a 10-year time frame. And if we go out 30 years, that number is just 2 out of 100. This 2% of investors are your Warren Buffetts and Ray Dalios of the world. It's been said that you have just a 1 in 49,000 chance of beating the S&P 500 over any given 30-year time period by picking stocks. Are you still ashamed to be an average investor? Somehow, without picking a single stock or mutual fund, you managed to beat 98% of fund managers, hedge funds, and stock pickers. This is the power of the Simple Path to Wealth strategy, and it's the reason this portfolio has created so many millionaires over the years. When people choose not to invest in the index and instead pick stocks, they're effectively saying that they believe they're better than 98% of all the people participating in the market. Investors that pick stocks generally use two core concepts: technical analysis and fundamental analysis. Both these topics deserve their own video, so I'm not going to get too deep into these ideas, but here's a quick primer. Technical analysis is based on Dow theory, and it tries to predict future price action based on patterns in previous prices. If you're interested in this, which I assume most people aren't because this is my worst performing video, I made a 10-minute primer that introduces Dow theory, and in that video we wrote some computer code to perform automated trading just like the professionals do. Fundamental analysis is a process where investors analyze various factors pertaining to a company, such as their price-to-book ratio, price-to-earnings ratio, return on equity, debt load, and literally hundreds or thousands of other financial spreading data to try to find bargain prices. Said another way, the fundamental analyzer is looking for pricing inefficiencies in the market. You should know that in academia there's this prevailing belief in an idea called the efficient market hypothesis. Long story short, the theory says that because all company information is equally available to all investors, any data that might give one investor an edge is no longer valuable because that information is universally known to all investors. In earlier generations, when Benjamin Graham was creating fundamental analysis, it was hard to get relevant data about companies. So anybody who knew how to get that data, and more importantly knew how to analyze it, had a distinct advantage over other investors who were more or less just guessing which companies might make big moves. Times have changed, and even Graham himself was quoted before he died as saying that he didn't believe fundamental analysis would remain a valid strategy as access to technology and information continued to proliferate with the development of new technology. Let me just say that efficient market hypothesis doesn't say that inefficiencies don't exist or that it's impossible to make winning bets. It just says that over long periods of time, it is very, very difficult to outperform the market average, and all the research bears this out. At this point, index investing has been around long enough, and its results have been so impressive that most investors have more or less accepted the power and value of index investing. Where investors run into real trouble today is when it comes to risk management. This is a monthly chart of the S&P 500 ETF, ticker symbol SPY, from 1992 to 2020. You can see that it took the S&P 500 index nearly 13 years to recover from the stock market crash of 2000, and it took 5 years to recover from the crash of 2008. If you were at the beginning of your investing journey, then these crashes were a stroke of great luck for you. But if you were at the end of your journey, nearing retirement, or just beginning retirement, you were essentially wiped out. This is the danger that everyone ignores when it comes to the simple path strategy. As you get nearer and nearer to your financial goal, it's imperative that you reduce your risk by decreasing your stocks exposure. Once you've met your goal, you can then slowly begin increasing your stock exposure again based on how the market is doing at that time. The simple path strategy is a great one, and its longevity and popularity speaks to its value. Investors just need to be sure that as each year passes, they're properly accounting for risk so that a sudden market event doesn't derail their timelines. So what did we learn today? Well, it might seem from this video and some of my other portfolio analysis videos that I don't like the simple path strategy. Nothing could be further from the truth. I have several of my own portfolios invested in this strategy. For example, my kids' 529 and ESA accounts, as well as our HSA account, are all invested in a version of the Simple Path portfolio. The Simple Path to Wealth portfolio is my go-to strategy that I recommend to pretty much everyone just starting out on their savings journey because it's so powerful and easy to implement. You just need to be aware of your timeline and reduce your risk exposure as your timelines for needing the money approaches.